Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we going to talk about? Well, I'm going to continue to follow up on my next 100 trades, and that's going to make sense in just a few minutes. A couple of mystery charts updates this week. And then, as you know, as I've been going through these, a few things have been coming up, such as stock picking and money management, etc. But not a whole lot new this week, and we'll get to that in just one second. I want to continue with the Mine Your Trade series. And this week, I want to talk about your mine on trades, and I want to continue that conversation. Last week, my producer Rachel took the titles I threw out, and then she came up with her own, your mine on trades, and I really like that. And I want to go back, recap a lot of the stuff that we've already done, a lot of the ground we've already covered, so we can build on it from there. And that'll make a lot more sense. And believe me, trading psychology is really the most important thing when it comes to trading. Everything else is secondary. Housekeeping, by the way, I do take requests. If you want me to cover something, davelandry.com/contact, be happy to do that. If I can't fit it into this venue, every Thursday night I do a webinar. Register at that link, even if the date is old, and one day I'll probably just take the date out. But if you do register, you'll be good for the next 6 months or so shows, whenever I do shows. Usually every Thursdays, occasionally holiday or travel, whatever, I won't do a show. If you would like some follow-up information, davelandry.com/StockCharts. I'll send you the slides from these presentations, every other presentation I've done for Trading Simplified, and a bunch of other stuff. All right, let's follow up on a couple of mystery charts, talk about the methodology and action, and my next 100 trades. Now, we'll go through this pretty quickly. There's going to be zero hindsight in all these, as you know. Warts and all, so far, I haven't really knocked your socks off, but I'm not dead yet, as the Python boys once said. Anyway, here's an update. This was a former mystery chart, I do believe. EMBC, that was the original setup. You can see these original setups after they occur at davelandry.com/archives, and I'll give you a link in a minute if you want to see them ahead of time, in other words, before they trigger. But you can see nice little thrust from lows. It was also a bigger picture cup and handle in an IPO. I do like sometimes when IPOs kind of get a little ahead of themselves, take off, and then they bottom out, and then they take off again. And I hate to use the word hope, but hopefully that's where we are now. On this one, I did get in a tiny bit late. I showed the trades over the last couple of weeks, so if you want to go and see those actual trades, you can go in and watch those shows. And what happened is I took partial profits slightly early in this case because it was the first day in the trade, and it was fairly close to the IPT. So I went ahead and took those partial profits a little early. And when that occurs, you bring your stop up to break even. Now, in my case, I'm using a little bit of discretion because the stock hasn't officially hit the initial profit target. And I know some of my clients are still in it because they haven't taken those partial profits yet and moved the stop up to break even. So what I'm doing is I'm giving it a little bit of room so I can maintain the position along with my clients. Because I do take those actual trades. Obviously, everything is for hypothetical and educational purposes only. But the trades you'll see in the spreadsheet, which I'll show you in just one second, are all taken by me, or I take all those trades, I should say. Anyway, VERV was another one. It did trigger an entry, and there are your parameters right there. 26, entry, protective stop of 18, initial profit target of 34. Now that one's kind of crazy. It had a risk of 8, but notice that we only were going to put on 250 shares per 100K, and I actually put on 300 shares in the account that I use for my model for the portfolio. Anyway, as you can see, it did hit that IPT, so the stop comes to break even. And fortunately, it's continued a little bit higher. Not lately, but initially it did, so we trailed that stop a little bit higher. And that's one of the secrets to trading, in addition to understanding your trading psychology and a little bit of neurology, and we'll touch upon that in one second. But the other secret, so to speak, is getting in for a swing trade and getting that stop to break even for a free position, so to speak, and then allowing that stop to gradually loosen over time as the market moves in your favor. So how am I doing? Well, so far I haven't knocked your socks off, but we'll get there. So last week, down 190 bucks. As you can see here, what I did was, after a few trades didn't work out so well, I decided to just focus mostly on my core methodology, and I'll show you why in one second. And this week, well, we had a little bit of an improvement, and this is as of last night's close. And so far, the positions really aren't getting hit much today. So we'll see how it all shakes out. Now, here's the thing. There just hasn't been a whole lot of action lately. And that's okay. And as I posted in Facebook this morning in my Facebook group, and I talked about in the week of charts, last night in my trading service, I said, it's better to be on the dock drinking beer, wishing you out to sea, than out to sea, wishing you were on the dock drinking beer. And I've been out to sea a few times and nearly sank in the race one year to Bermuda. And I've been caught in low pressure systems and other nasty situations. Believe me, I've been wanting to be back on that dock on more than one occasion. All right, so for what it's worth, here's the service portfolio. And the reason I want to show you this is the ultimate goal, to capture a big winner like this, up 400%. We got into this below $5 a share, and based on 2,000 shares on a 100K account, there's been, I think, about $1,400 in dividends so far, which is odd because rarely do I ever buy a stock that has dividends. Usually these high growth stocks, such as something like Verve, is not going to have a dividend. But anyway, that's the ultimate goal. And on a 100K account, obviously that's a 20% move, 21%, maybe a little higher, 23 or 24% if you add in the dividends and everything. But obviously there's some losses along the way. But this is what makes the methodology really work. Shorter term trading just doesn't make enough money. And it feels good, and your accuracy is going to be a little higher, but occasionally you're going to get whacked, maybe like on a day like today, and give up a lot of those gains, especially if you just got into a position a couple days ago. So you can see the Verve trade and the EMBC down here. I split these trades, by the way, into two loaves, a trading loaf and a trending loaf. So ARLP and Verve hit the IPT. I did take partial profits already in EMBC. That one hasn't officially hit it yet, but I did use a little discretion on that. And the idea is once you get that initial profit target out, the swing trade, so to speak, then you trail that stop more and more loosely on the remainder in an effort to capture a longer-term trend. Now, if you take a look at the two that are open in the portfolio that have been open in more recent times, the Verve and the EMBC, you add it all up, it's better than a poke in the eye. That's not the ultimate goal to make a little bit. The ultimate goal is to make a lot on the trade. And the way you get that, to get to that goal, is you just chip away at it, chip away at it, chip away at it, and eventually catch one, and you ride it for a long, long time. We are coming up, I think, on 2 years. I guess it'll be right around January. It'll be 2 years into that trade. I'm slotted as a swing trader, and in my first two books, they put the words swing trading in the title, but the reality is I will hang on to positions as long as they move in my favor. In other words, as long as I'm not stopped out. Now, if you want to see some more trades of mine, remember this next 100 trades, I'm focusing mostly on the core methodology as they occur with the service, and possibly anything I throw out in Facebook and IPOs possibly too, when the IPO market heats up again. Right now, the IPOs aren't that hot. As one person in my Facebook group says, IPOs suck lately. He's a resident guru, and he's right. It makes me feel a lot better, and that's something I'm going to get into in a lot more detail in the upcoming weeks, is the fact that this could be a really lonely sport, and it does help having a bit of a support group out there to confirm what you're seeing or not seeing. Anyway, if you want to come to my Thursday shows, again, davelandry.com/webinars. These are live shows still. Hopefully this Trading Simplified show will return to being live soon. I know they're working on a studio, and hopefully they'll have that up and running soon. If you would like to see my recommendations ahead of time, this is a paid service, but if you want to see these trades as they are recommended, you go to davelandry.com/trading service. If you want to see the archives, davelandry.com/archives, and I just updated them a few days ago, so you'll be up to speed pretty quickly. Facebook access, you have to at least be a gold member of my website, and there's a link there, davelandry.com/become a better trader. A couple of random thoughts, and I've been talking about these quite a bit, so I'm just going to kind of talk about them a little bit. I want to be careful not to just take profits so I can show you profits, but make sure I'm taking enough profits when I do exercise a little bit of discretion. And again, go in and watch last couple of weeks' shows for a lot more on that. And you've got to be careful with the Einstein's definition of insanity versus the Churchill's definition of success. Einstein's definition of insanity is doing the same thing over and over and expecting a different outcome. And Churchill's definition of success is going from one failure to another without no loss of enthusiasm. And as long as you're doing the right thing, it becomes more of Churchill's going from one failure to another without loss of enthusiasm, provided you're picking the best stocks going in, sitting on your hands when nothing else is working. But you will have that Einstein's definition of insanity feeling sometime. Now, the core methodology, as I've been saying, doesn't work all the time, but it does work over time. Now, last week I talked about before, during, and after the trade. And my producer, Rachel, when I gave her some potential titles for the show, she retitled it Your Brain on Trades. And I really like this title. In fact, maybe that's going to be the title of our new segment. Anyway, thanks to Rachel for that. One thing I've been thinking about a lot, and I am going to reiterate and beat the dead horse a little bit, and I do that a lot. And there's two reasons why I do that. Number one is I want to build a base and then really build upon that once we get a nice base built on this. And number two, it's kind of like the Anthony Robbins talk where he talked about the preacher who was saying the same thing every week. And then one of the parishioners came up to him and said, I can't help but notice you're saying the same thing every week. And he says, yeah, I'm going to keep saying that until you people get it. And you know what? I need to get it too a lot of times. But the thing about psychology is, getting back to trading psychology before I digress too far, imagine that, is that you really almost have to go out and lose a bunch of money before you appreciate it. But you really, really have to appreciate it to avoid losing a lot of money. That's one of the pieces that I'm working on, is dilemmas and paradoxes of trading. Now, over the past several weeks, I've been talking a lot about your life and your trading. And believe me, I'm as guilty as anyone. And you've got to be careful of what's going on in your head that has nothing to do with the markets. And you can see on the left side, I talk about a lot of things that might be going on in your life. As I've been saying lately, every time I walk in the house, my wife hits me with something. Okay, my AC's out in the car, $200, I got it fixed, fantastic. The next day, hey, my AC's out in the car, $1,500. It's like, oh, great, you know? And I know these are first world problems, but it's still a problem nonetheless. And I've got to be really careful. I have to be really careful not to come back into my office and say, how can I pull that $1,500 or a lot more in a lot of cases out of the market, and just let the market come to me. And there's a mouthful right there, believe me. Now, another thing we talked about was the 2 U's, and a lot of this research comes from Brett Steenbarger. And I thought it was really cool when he explained that literally different parts of your mind work in the trade. And I've been kind of noodling with that a little bit and exploring that a little further as of late. So as I've been saying, before the trade, you're really pumped up and you're pretty excited. And during the trade, there's often a lot of stress involved. And those are two completely different things. And believe me, the right side of the chart, once you are in a position, is much harder than the left side of the chart before you get into a position. Now, I'm a big fan of epiphanies, and it's not like I have these huge epiphanies when it comes to trading, but I have these little small epiphanies, and a lot of them come from doing a lot of reading and things that are not necessarily directly trading related, but maybe related to neurology or psychology. I know you probably want to party with me. But I like this definition here. Number 3, a sudden intuitive perception or insight into the reality or essential meaning of something, usually initiated by something simple, homely, or commonplace occurrence or experience. And you will have these little tiny epiphanies over time, and hopefully I can get you to some of those epiphanies. And one of my epiphanies was in reading The Molecule of More. And I'm not sure who recommended this book. I'm going to give Charlie Kirk credit because I get a lot of good stuff out of Charlie. Good friend of mine, Charlie Kirk. I would recommend you check him out. But before the trade, what I found interesting in the book is you're in that anticipation mode. And when you're in anticipation mode, you're full of dopamine. And dopamine is not necessarily the receiving of pleasure, but it's more about the anticipation of pleasure. If you think about going to a new restaurant or going somewhere fun, you're really, really excited, but then when you're actually there, it often won't live up to your expectation. That's the anticipation of pleasure. And in the book, they talk a lot about how you go from compassionate love to companionate love. And you have to make that turn. If you don't, then obviously you don't end up together. But a lot of people, they're so passionate about the love, and all of a sudden they're like, well, what happened to the love? Well, you go from that anticipation to the here and now, and the neurotransmitters change. And I know, once again, you want to party with me, but you go from that dopamine to the serotonin, the oxytocin, the endorphins, and the endocannabinoids. So it's a completely different thing. You fall in love with someone, and they're just great, and they're awesome, and then all of a sudden you move in together, you get married, and then all of a sudden it's the living and the day in and the day out, and you definitely have to make that transition. Well, the same thing happens in trading. You have to make the transition to accepting the risk of the trade and accepting the risk and the nature of what you might be trading. And the example I've been given lately is that Verve, V-E-R-V, that thing can bounce around 4 or 5 points a day. And if you watch it all day long, you're really going to stress out. And then here's another one of my little epiphanies about trading. A win makes you feel pretty good, but a loss makes you feel really, really, really bad. And that's what leads to gamblers' ruin. They end up chasing that high. Well, us traders in the market, we've got to be careful too, because we could easily end up in that gambler's ruin in the market if we're not really, really, really careful. Now, as I said over the past few weeks, there's all types of emotions before the trades, and I'm not going to show you all of them or talk about all of them, but obviously there's quite a few things that happen in your brain that are fed by that dopamine, and one would be enthusiasm, right? Enthusiasm is my second favorite asm. And if you want to know the first, well, I'll go ahead and tell you, it is sarcasm. I could be sarcastic. Anyway, during a trade, obviously, there'll be fear and all types of other emotions. And there's the known before the trade. Everything is statistical before the trade. You look at this chart, and this is a nice little TKO, and this is an actual trade we took a few years back. I don't know if this part is exactly how it shook out, but it did take a while to get going, if memory serves. But this is what it looked like, and you can see this is a great looking stock. It took off, nice little trend knockout mode, nice little trend knockout, and then you move into the unknown, and all of a sudden it becomes the here and now and the reality. And so again, logic is on one side, emotions on the other, and statistical and irrational. I said I wouldn't go through them all, but I'm going to go through them all. That's a big thing too. You know, you have to accept the fact that you're very emotional. As I've said in the past, we are emotional beings. We cannot make any decisions without emotions. And if you think about it, you're trading traders and not the market. So there's a lot of other emotional people just like you. Now, the point and the reason I'm beating a dead horse so much and showing that slide once again is that once you're in a trade, things really, 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 really change. Now, I did a presentation a while back on the perception prism, and I think it kind of dovetails into everything we're talking about today and recently. And we don't see the markets as they are. We see a perception of the market, and that perception prism, all those things that I showed in your brain were in this were within this prism, and a lot of things that have nothing to do with trading can affect your trades. I love this little book, The Psychology of the Stock Market, and one of the things he talks about is how we don't see markets how they are, we see them as how they want to be. And I think this is the public domain. You should be able to download a PDF. I've lost my copy so many times. I've bought a half a dozen of them. It's like when I go to Harbor Freight, you know, sometimes my wife will be with me, and the first thing I do is I go grab a tape measure. She goes, "How many tape measures do you need?" It's like, well, just need one, but I need to be able to find one. And cleaning a garage the other day, I know it's kind of shocking, but I found maybe a half a dozen or maybe even more. Anyway, this book is like my tape measure fetish. I've probably bought about a half a dozen copies so I could find it easily. But I would recommend you read it. Go to davelandry.com/books-2-read. And this was written in 1912, if memory serves, so well over 100 years ago. And way back then, G.C. Selden knew there was a neurology involved in trading and certainly a psychology. And he said the average man is not blessed or cursed, however you may look at it, with an analytical mind. We see as through a glass darkly, and it may be where my perception prism came from. I'm not sure. Our ideas are always enveloped in a haze, and our reasoning powers work in a rut from which we find it painful, if not impossible, to escape. Many of our emotions and some of our acts are merely automatic responses to external stimuli. I've talked about that a lot of times before. You have this lizard brain down inside your brain, down below the neocortex, the new part of the brain that's sloshing around up there, the part that you think that's, when you think of a brain, you think of that, the neocortex, but underneath that is this little lizard brain that can control a lot of your emotions. And you need that little lizard brain to make a quick decision like, hey, I'm going to step out on this curb. I better jump back, though. Here comes a cab. You can't sit around and contemplate your navel and think, hey, what if that cab driver doesn't like me and maybe that's why he's going to hit me? You just have to let that little part of your brain take over. Unfortunately, it could kill you in trading. And one of the simplest things you could do, by the way, is just count to 3 before placing a trade to make sure you really want to do that. You need to slow that part of your brain down. Anyway, I digress as usual, but as Selden said, wonderful as is the development of the human brain, it originated as an enlarged ganglion, and its first response is still practically of that ganglion. So the first response is to be very, very, very emotional. Now, there's 4 F's when it comes to the brain: flight, fight, food, and can anyone think of the other one? Yes, fornicate. Very good. So obviously your right brain is very artsy and kind of picture oriented and all, and your left brain is more statistical and numerically oriented. Now you need both sides of your brain, but keep in mind that different parts of your brain take over during the trade, as I've been preaching. So before you trade, it's more of the new brain reasoning and more left brain logical and statistical and things like that, like I talked about earlier. The old brain is more emotionally charged, the lizard brain, so to speak, and the right brain is more emotional too. Now, one thing that Curtis Faith said in Trading from the Gut was to send it over to the other side of the brain to check it out. So once you're in a trade, you need to take a whole-brained approach. Curtis Faith, a bit of a character. I swore I would never read these turtle books. And Larry McMillan, when I said that once, he said, you know, that one that Curtis Faith wrote was pretty good, and that's The Way of the Turtle, I do believe. But make sure, because there's some imposters out there, so to speak. And then after I read that, Faith mentioned Trading from the Gut, and that was a really good read. And he mentions another book in this book, but I think he might not have gotten around to writing it. He might be incarcerated. Poor guy. But anyway, I digress. And he said the brain is not designed to process the type of low probability outcomes that traders often encounter, where losing is part of the brain. So amen. Where I'm going with a lot of this is we're just simply not made to trade, and you have to embrace that. And that's why I'm kind of beating a dead horse on a lot of things I've already covered so it can sink in. One thing that Douglas once said, the late great Mark Douglas, is if you could put on a trade without hesitation / take it off without emotional discomfort, then you have accepted the risk. So I think that dovetails in to a lot of things that we've been talking about as of late, the before trade and then the accepting of the during trade. And not to go all Sun Tzu on you, but basically the battle is won long before the battle. And one thing we've talked about quite a bit is present Dave going to make future Dave mad? This is a fortune cookie I found a while back when I was doing one of these presentations. And it says the best way to predict the future is to create it. Now, here's a few things that might make future Dave or future you angry. Taking mediocre setups, trying something new without loads of testing, trading when conditions are less than ideal, S&G trading or trading not to lose. You go in and say, oh, you know what? The market sold off hard. I'm going to buy a little bit, put a stop just below the low. Well, that's a losing strategy right there. Now, another thing that can make you angry is actually missing a trade, and this could really make you angry for a long time, as I've said before, and that's not taking a must-take trade due to recent life or trading, as I discussed earlier. And that could really mess up your life. And look, it's such an important point. I said it again. Well, I have so much more to cover, and I barely even scratched the surface here, and I'm already out of time. So thanks for bearing with me as I work through this. If you're looking for some follow-up information, once again, DaveLandry.com/StockCharts. And if you need to reach me, DaveLandry.com/contact. I promise you, I have a lot of tools and a lot to cover, and I'll be covering more and more of this over the next several weeks. I want to thank everybody for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.